Today we are going to do the June 2023 paper 1. So we'll be doing question 1. So let's go into it. The information relates to Mindros Ltd for the year that ends on 28 February 2023. So now we know that our year ends on 28 February. Right? So, and then they're saying required. Refer to information B, Roman figure 1 and Roman figure 2. Calculate 1.1.1 the profits or loss on the trade-in of the old vehicle. And then we're also told to calculate the total depreciation for the year 1.2. Complete the following for the year ended 28 February 2023. We're told to do the income statement and also the equity and liability section of the income statement. Of the statement of financial position, which is a balance sheet. And then they say, note some amounts are provided in the answer book. So let's continue. Let's go to the information. Information B. The following transaction was not recorded. So you're saying it was not recorded. An old vehicle with a cost of 270,000. So we have a vehicle with a cost of 270,000 and then was traded in on 28 February 2023 for a newer model which cost 616,500. Now what happens is this. When the vehicle is doing a trade-in, the vehicle does a trade-in when they are buying a vehicle on credit. Then they do a trade-in so that they will be owing the dealership a lower amount since they are going to pay some of the amount by trading in an old vehicle. So in that way, the creditors' control decreases because now we are going to owe the creditors a lower amount. Okay? So the accumulated depreciation on the trade-in date was 111,240. Now, if we were told to do the asset disposal account, we are going to come and open it, asset disposal, right? So then we have the vehicle's cost price of 270, and then the accumulated depreciation of 111,240. Then the trade-in value for the old vehicle is how much? 105,000. So when you're trading in the vehicle or when you're trading in the asset, we call that the creditor's control because actually we are going to decrease the creditor's control with this amount since we are going to owe the creditors a lower amount. So we're going to go to the debit side of the debtor's control and decrease the amount to 105,000. Then from here, we are checking which side is big. So you can see that the bigger side here is the debit side. So it is 270,000. So when you are doing the asset disposal, if the debit side is big, it means that there is a loss. So 270,000 minus 105 minus 111,240, that is going to be 53,760. So this means that there is a loss on sale, which is going to the income statement. So, but then we were told to do it here. Right? So let's come and do it. 270,000 minus 105,000 minus 111,240. So the answer here is 53,760, which is the loss on sale of the fixed asset. So this is an expense which must go to the income statement under expenses. Loss on sale of the fixed asset, 53,760. Right? So while we are still there, we did a trade-in. Right? So the trade-in rate is 105,000. So we have to go and decrease the creditors control with this amount. But before we do that, we must also go and increase them with the 616,500, because actually the creditors control, they are supposed to increase it with this amount since we are buying a new vehicle. But because there's a trade-in value, so now they are going to increase with a lower amount. So it means that it's going to be 616,500 minus 111,240. So 616,500 minus 240, that is going to be 505,260. So that is the amount that is going to be shown under creditors control. So the creditors control right now is 448,725. So we know that the creditors control, it goes to the balance sheet under trade and other payables. So 448,725. So we can do it this way. We can show this, you see, plus 616,500 minus this one, or we can just show this 505,260. Okay, let's continue. So what else? Depreciation on vehicles is calculated at 20% per annum on the diminishing balance method. Now, if you can remember, in 1.1.2, we were told to calculate the depreciation on the vehicles. Now, I need to remember this. The year ends on 28 February 2023. So it means that this year starts on 1 March 2022, right? Ends on 28 February 2023, right? So it means that, right? So it means that, let's come back here. So it means that this old vehicle that was traded in, it was traded in at the end of the financial year, meaning that it stayed for the whole 12 months. So this means that when we are calculating the depreciation for the vehicles, so they are given here, the vehicle. So they said balances and totals from the records on 28 February. So it means that these vehicles, they are the balances on 28 February 2022. So it means that they are going to be the opening balance on 1 March 2022. So these are the opening balance. Now, because the trade-in happened at the end of the year, when we are calculating the depreciation, there is no need for us to come and subtract the cost of this vehicle, the one which was traded in, and also subtract the accumulated depreciation, because both these vehicles, the one that is still remaining in the business and the one that is being traded in, both of them is stayed for the whole year. So you can just use this whole amount to calculate the depreciation. So it's 1,350,000. So we're using a diminishing balance method. So we must minus the accumulated, which is 855,000. So 1,350,000 minus 855,000. That is going to be 495,000. That is your carrying value. So the diminishing, you see, at 20% per annum on the diminishing. So we're going to come here and say multiply by 20%, multiply by 12 over 12, since it stays for the whole year. So 495,000 multiplied by 20%, that is going to be 99,000. So this depreciation, it is going to go to your income statement. Depreciation. So we have 99,000. Then now we must look for the one for the equipment. What are they saying about the equipment? Depreciation for the year. Depreciation on equipment was brought into account. Make provision for depreciation on the vehicles. So they're saying that the depreciation on the equipment, it was already calculated. It's already brought into account. So now let's go and check the one for the equipment. Now, if you can check the opening balance of the accumulated depreciation for the equipment and the closing balance of the accumulated depreciation for the equipment, the accumulated depreciation, the closing balance has increased. So it means that obviously this depreciation has already been brought into account, which is what they've already said. So it means that if we want to find the depreciation, we have to find a difference between the two. So 923,260 923,260 minus 800,900. So 923,260 minus 800,900. That is going to be 122,360. So which is going to your income statement. So 122,360. So 99,000 plus 122,360. That is going to be 221,360. Right? So let's continue. Let's continue. Problem figure 3. An invoice of 28,000 issued to a debtor. So meaning that we were selling the goods to a debtor. So if we are selling the goods to a debtor, debtor's control, they have to increase. Trading stock has to decrease. Cost of sales, they have to increase. And also the sales, they have to increase. But then they are saying purchase for goods purchase on 28 February 2023 was incorrectly recorded as a credit note. So it means that it was recorded as if the debtors are returning the goods to us, while the business was selling the goods to the debtors. So because it was recorded this way, it means that instead of increasing the debtors, they decreased the debtors because they recorded as if the debtors are retaining the goods. And then they also recorded it this way under debtors allowances since it's a credit note. So we know that the credit note, the debtors allowances, they decreases the sales. So it means that they also decreased the sales. Why they were supposed to increase them. And then it means they did what? They also increased the trading stock because it was as if the debtors are retaining the goods. And then it means they decrease the cost of sales. Now remember, the section that we are doing, right? The section that we are doing, it's a section for the, in the balance sheet, it's a section for the equity and liabilities only. It's a section for the equity and liabilities only. So it means that we can't record this under the best control because they're not there, and even the trading. But the trading stock, remember, it can affect the it can affect the income statement. So let's check if we do have the trading stock that is written here. So if you can check, we don't have the trading stock. Let's go and check the transactions. Okay. That is not given here. Okay. So it's not given. So let's leave it. Now, back to the sales and cost of sales. So here, we have got the net sales. Net sales, it means that the debtors allowances, they have already been subtracted. So it's 11,724,000. Cost of sales, 7,363,500. So let's come back here. Let's come back. Okay. We are not given the cost of sales. So remember I said that we were supposed to come and increase the sales, but the sales, they were decreased since it was as if the debtors are retaining the cost. So it means that we have to go and increase the sales twice with this 28,800. So now why are we doing that? The reason is because we are adding the 28,800. The one that we subtracted by a mistake because we're not supposed to do that. And then now we are adding the one that we're supposed to add. So let's come and calculate 28,800 multiplied by. So we have cost. The cost is already 100%. Markup is given as 60%. So the selling price is a made up of cost plus markup, so which is 160,000. So below we are going to put what we have, which is 160. Then above we are going to put what we want. So what we want is the cost price, which is 100%. So this is going to give us 18,000. So we have to go and increase the cost of sales twice. Now, why are we doing that? It is because when the debtors were retaining the goods, when we incorrectly recorded this as a credit note, it was as if the debtors are retaining the goods. So meaning that the cost of sales, it was decreased, and the trading stock, it was increased. Right? So, but then here, we don't have the trading stock. It is not given. Let's continue. An amount of 3,260, which was not received from an insolvent estate of a debtor, must be written off. So we are told to write off a debtor. Let's go and check the bad debts. 15,090. Bad debts. 15,090. Then we are told to write off another debtor. So for 3,230. Right? Roman figure 5. Provision for bad debts must be decreased by 2,000. So when we are doing the provision for bad debts, if the provision for bad debts in the adjustments is bigger than the one in the trade balance, that difference is going to be the provision for bad debt adjustment, which is going to be recorded under the expenses. But if the provision for bad debts in the adjustment is smaller than the one in the trade balance, it means that it has decreased. So that difference is an income that must be recorded under operating incomes. So let's go and record this 2,000 under operating incomes. So as a provision for bad debts adjustment of 2,000. Right? So let's continue. The rent increased by 10% per month with effect from the 1st of September 2022 as per the lease agreement. Rent is received until March 2023. So how much is the rent? The rent it was given as 174,675. Rent income 174,675. The rent is 174,675. Right? Now what are they saying? They are saying the rate increased by 10% with effect from the 1st of September 2022. Remember, the year starts on 1 March 2022. So this means that this rent from 1 March to 31 August, before the 1st of September, the rent per month, it did not have the increment of 10%. But from the 1st of September 2022 to 31 March, because we also received the rent for March 2023, now the rent had an increment. So this means that we can say that from his first month, the rent it was 100% per month. Then from the 1st of September, the rent it was now 110%. Now, it was 100% for how many months? March, April, May, June, July, August. So for 6 months, that is going to be 600. This one for how many months? September, October, November, December, January, February, March. That is 7 months. So that's going to be 717. Right? So this means that in total, the percentage for the rent received is 600 plus 770. So which is going to give us 1,370. So it means that we're going to say 174,000 multiplied by. So below we are going to put what we have. So what we have is a rent of 13 months. So we do have the percentage of 13 months, which is 1,370. So we are looking for the rent of March. The rent of March, it is including a 10%, meaning that it's 110%. So how much is that? 174,675 multiplied by 110 divided by, that is going to be 14,025. So it means that now we have found our income receiving advance because we received the rent for the month of the next financial year, which is March. So this is an income receiving advance, which must go and subtract in the income statement as 14,025. So the income receiving advance, we must also go and record it under the balance sheet, under trade and other payables, 14,025. From figure 7, extract from the salaries journal for February 2023. So we are given deductions, net salary, and contributions. Total gross salary. So the total gross salary is made up of deductions and net salary. Was not posted to the general ledger. All relevant payments to the salaries were made, meaning that the payments were made. The only thing which was not done was to post to the general ledger. So it means that these deductions and the net salary, it's not an accrued income. It's not an accrued expense because the payments were made. It's just that they forgot to post to the ledger. Remember, the accrued expense, it is when we did not pay. We still need to pay. This one is not an accrued expense. I just said it was not posted. So let's go and record it. The gross salary. So we must go and increase our salaries. So we have to code the salaries and wages, 982 to 90. Salaries and wages, 982 to 90. So plus. So we must go and add the 1 posted. So which is the gross salary made up of deductions, 15,600 plus 47,330 Let's continue. From figure 8. The company had 5 directors until one resigned on 30 June. Now, the year starts on 1 March 2022, right? They are saying that the company had 5 directors until one resigned on 30 June. The one who resigned was only replaced on the 1st of October 2022. So this means that from the 1st of March 2022 to 30 June 2022, we had 5 directors. Then from the 1st of July 2022, till we got a new director from the 1st of October. So it means that 2 30 September 2022, we had how many directors? 4. And then from the 1st of October 2022 to the end of the year, because they're saying all directors are on the same fee, the fees for 2 directors for February are still outstanding. So to February, 28 February 2023, we now had again 5 directors. So now let's come back here. So it's 5 directors. Remember, these directors, they are earning the same amount per month. So all these directors, they're earning for this month. So it's March, April, May, June times 4. So it means that these directors in total, they earned for 20 months. And then it's July for this one, August, September. So we had 4 directors for 3 months. That is going to be 12. And then from the 1st of October 2022 to 28 February, October, November, December, January, February, for 5 months, we had 5 directors. That is 25. But remember, 2 directors, the fees of 2 directors for February are still outstanding, meaning that they were not paid. So it means that in these directors' fees of 1,925,000, directors' fees, $1,925,000. So it means that in these directors' fees, there are 2 fees of the 2 directors that were not paid for February. So it means that in this 25, we must come and subtract the 2 of the directors. It means that in total, it is going to be 23. It's supposed to be 25, but then 2 fees for February for directors were not paid, so we must subtract them. So this means that in total, the months, the total months that these directors got paid, it is going to be 20 plus 12 plus 23. So it's 20 plus 12 plus 23. That is going to be 55. So now, if we want to know that how much is director's fees per month, because remember they said it's the same fee. If we want to know that how much are the director's fees per director, we're going to say 1,925,000 divided by 55. So 9,925,000 divided by 55. That is going to be 35,000. So it means that the fees that are still outstanding, it is going to be 35 multiplied by 2, because each director is earning 35,000. So it means that there's going to be 70,000 fees that are still outstanding, which is an accrued expense. So we must go and add it to the director's fees, 70,000. But remember, the accrued expense, it must be recorded under trade and other receivable. Trade and other payables. Plus 70,000. Right? Then they're saying, the income tax for the financial year was calculated as 242,040. Right? This is 80% of the net profit before tax. Okay? Before we go there, we are given the income tax. So it means that we are supposed to pay SARS this amount, 242,040. Now let's go and check that how much did we pay for SARS. SARS provisional payments, we paid 196,040. So it means that we paid SARS a small amount. So if we paid SARS a small amount, it means that we are still owing SARS. Now we need to see that how much are we owing SARS. So we were paying SARS how much? 242,000. we were supposed to pay SARS 242,040. 242,040. But we paid SARS 196,040. So it means that we are still owing SARS. But we are owing SARS how much? So we are owing SARS how much? We are owing SARS 46,000. So if we are the ones who are owing SARS, that is going to be a liability which must be recorded under trade and other payables. So sometimes it may be recorded as SARS with the credit balance to show that we are owing SARS. So 46,000. So we come and edit plus 46,000. So then let's come back here. So because we are given the income tax 242,040, it is 30%. So let's go to the income statement. So it's recorded here. It is 30%. So we know that the net profit before tax, this one, it must be 100%. So then the net profit after tax, so we have deducted income tax. So after income tax, it is going to be 70%. So now we can find the net profit after tax and the net profit before tax. So let's start with the net profit before tax. It is going to be 242,040 multiplied by. So below we are going to put what we have. So what we have is 30%. Then what we're looking for is 100%. So then net profit after tax, we must say net profit before tax minus income tax. So 800,000 minus 242 and 40. $760. Right? So let's continue. Let's say the loan statement received from Somerville Bank reflects the following. Balance of the loan at the beginning of the financial year, that's given, and then we are given the balance at the end of the year for the loan, 1,125,000. 1,125,000. The loan, 1,125,000. The balance at the end. Now let's see what else did they say. They said repayments including the interest. These are the repayments. So if you can check, the loan has decreased. At the beginning of the year, it was 2,205,500. Now it is 1,125,000. So it means that there is a payment that was made. So we need to find that payment. So we have to find the difference between the balance at the beginning with the balance at the end. So that's going to be 1,080,500. So it means that the loan decreased with this amount. But this repayment, it is bigger than this one. Why? It is because this repayment, it is including the interest. Because remember, when they are saying interest is capitalized, it means that the repayments are including the interest. So because in here we're looking for the interest, that is going to the income statement. So now we have to find out the difference between this repayment that is including the interest. So it's 1,260,000. This is the interest expense, interest on loan. So it's 1,260,000 minus 1,080,500. So what is the answer? 1,260,000 minus 1,080,500. That is going to be 179,500. So it must be in bracket. Then what else did they say? They said the loan balance will be reduced by 625,000 in the next financial year. So once a loan would be paid in the next financial year, that loan it no longer belongs under the non-current liabilities. It belongs under current asset as a short-term loan or current portion of a loan. So we must go and record it. So it's a short-term loan. So 625,000. But before we do this, we must come and subtract it here to show that it now belongs under short-term loan. And then total dividends for the year amounted to 410,000, which include an interim dividends of 160,000 paid on the 31 August 2022. Remember, the dividends, they are recorded as an expense under income statement. So as a dividends on ordinary shares under expenses. Dividends on ordinary shares, 410,000. But then the final dividends, it must be recorded under the current liabilities as a shareholders for dividends, is the dividends that the business is owing to the shareholders. It's a liability. So, but then in here, it is not given. What is given is the interim dividends of 160,000. But in here, they gave us the total dividends. So the total dividend, it is made up of the final dividends and the interim dividends. So it means that we can now find the final dividend by finding the difference between the two. So it is going to be 410,000 minus 160,000. So that is going to be 250,000. Right? So it means that now we are done with the adjustments. So let's go and see. He said the salary expenses is a balancing figure in the income statement. So let's also check if there's something that you still need to record in the income statement. So you can see that you have 62,620 employers' contributions. Are they recorded? They're not here. Employers' contribution. 63,620. So all of these are recorded. Retained income, it must be recorded in the balance sheet, 970,750. Retained 970,750 is the retained income, and then we have the ordinary share capital. So we can find the ordinary share capital because the ordinary shareholders' equity is given. So we just have to find the difference between the ordinary shareholders' equity with the retained income, because the shareholders' equity, it is made up of the retained and the ordinary share capital. 5,870,750 minus 970,750. So that's going to be 5,870,750 minus 970,750. That is going to be 4,900,000. So, okay, mortgage loan. So I've recorded it. That is already here. And then this one, it is the loan at the beginning. So just want the one at the end. And see, it was given below. And then sales income tax is recorded. Right? Provision for bad debts. We were going to use it if we were doing the trading other receivables under current assets, but we're not sure to do them. Fixed deposit, we're not doing it. So we are done. Let's go into the totals. So let's start here. Let's just come here. To find the profit before interest expense, because we are given the interest income, we just have to come back here. So can we find it? Yes, we can. Because to find the net profit before tax, we must say profit before interest expense minus interest expense, then we get this one. Now, to find it, it means that we must add it back, the interest expense. 806,800 plus 179,500. Then the 6,800 plus 179,500. That is going to be 986,300. Now, to find the operating profit, we know that to get the profit before interest expense, we must say operating profit plus income interest expense. Then we get this one. So in this case, to go back, we must separate the interest income. 986,300 minus 120. So that's going to be 866,300. Now with the operating profit. Let's totalize here. Bad debts, 15,090 plus 3,230. That is 15,020. Salaries and wages, 982,290 plus 15,600 plus 47,330. That is going to be 1,045,120. Directors' fees, 1,925,000. thousand plus 70. That is going to be 1,995,000. Right? So coming back here, the rent income, we have 174,675 minus 14,025. That is going to be 160,650. Now we can get the other incomes. So plus 2,000 plus 32,400. That is going to be 195,000 and 50,000. And then now sales 11,724,000 plus 28,800. So it's 11. And then the cost 726. Yeah. 399 500. Now we can find the gross profits. So which is 4,382,100. Now gross operating income, we have to add other incomes. So which is going to be 4,577,150. Then now to find the other operating expenses. We know that to get the operating profit, we must say gross operating income minus the operating profit. So it means that to get the operating expenses, we must just take the gross operating incomes minus operating expenses. So which is going to be 3,710,850. So we're done with the income statement. So let's go to the balance sheet. So balance sheet, the loan, mortgage loan, 1,125,000 minus 625,000. So it's going to be 500,000. 500,000. Then trade and other payables, let's calculate them. 448,725 plus 505, 260 plus 14,025 plus 70,000 plus 46,000. So that's going to be 1,086,010. So adding all this together, they must give us the current liabilities. I was just coming to check here if we forget something, because you never know, we might have forgot something. You can see there's nothing. Okay, let's add them together. Okay, let's recalculate because I think we made a mistake. 44,725 plus this plus this plus 70 plus 46,000. It's 0.84. 0.84. So now we have to add them together. So that's going to be 1,959,000 and 10,000. Now to get the total equity and liabilities, we have to add the current liabilities with the non-current liabilities. With the ordinary shareholders' equity, which is 5,870,750. So that's going to be 8,329,760. So means that we are done. We're done. We are done. We are done. Because everything is done right now. Thank you. Okay, so there was an error when we were recording to the creditors control. So the mistake that you made there is that you said 616,500 minus 111,000, which was a mistake. So in the following video, I'm going to be correcting that error. Thank you. Okay, so in here, the trade-in value for the old vehicle, it is 105,000. So it means that the creditor's amount of 616,500, it is going to decrease with this amount of 105,000. Right? So, which we are going to go and record in the balance sheet. So, 4 million, I mean, 616,500 minus 105,000. That is going to be 511,500. Right? Okay. Then now we're going to come and record this under trade and other payables. 511,500. So when we add all this together, so it's going to be 448,725 plus 511,500 plus 14,025 plus 70,000 plus 46,000 for the SARS income tax, which is going to be 1,090,250. So if you have a space like this, sometimes you can write the SARS income tax here. So it's going to be 1,090,250 plus 625,000 plus 250. So that is going to be 1,965,250. Right? So now this is going to mean that to find the total equity liabilities, we're going to add with the non-current liabilities plus the shareholders' equity. So which is going to be 8,336,000. That is your total equity and liability.